Welcome back, everybody. Now, for the past year or two, everyone's been talking about the coming recession, but all of a sudden, there's been a slightly different tune. Inflation data is coming in better than expected, home sale data coming in better than expected, consumer spending higher than expected, and maybe the best data was Walmart themselves saying in their latest earnings call that they don't project a recession based on what they're seeing. And of course, we're starting to see analysts say the same thing, with T.S. Lombard saying it's off, and even Goldman lowering the odds of a recession as well.
Meantime, Goldman lowering its odds of a U.S. recession in the next 12 months to 20% from 25%. And joining us to discuss that call is Goldman's chief economist, Jan Hatzius. Jan, great to have you, even remote. Thanks for being with us.
It's good to be here. Thank you.
I had to think on Friday when I read your note that retail sales and claims must have been pretty decisive for you to trim your odds so quickly after raising them.
Yes, I think they were definitely encouraging data points. Claims the last couple of weeks, retail sales, plus 0.7% if you take core retail sales and translate them into real numbers, inflation-adjusted numbers. But I think in general, the last couple of weeks have basically said that the economy is still doing fine. And typically when recessions occur or when risk is really rising sharply, things happen pretty quickly. So if you see a couple of weeks of data that say the economy is still doing fine, you want to put some weight on that. So we went from 15% to 25% after the employment report. We've now taken that halfway back to 20%. And we also said that if the August employment report that's coming up in early September, if that is okay or better, we'll probably take it back to 15%, which is the long-term sort of unconditional average probability of recession.
So I think the real question we want to know as investors is, what do we do with this information? Like, what's the difference between a 15% chance of a recession versus a 25% chance? And the reality is that for most people, the answer is probably not much, but we're bombarded with this info all the time. And I think there's a really important point that we're missing, which is highlighted by the next clip.
So how do you prepare for the risk of recession, even if that isn't the base case?
Yeah, I think investors need to be aware that recessions are not good for stocks. Most bear markets occur during recessions. So I think there's a real risk of it when you look at the employment rate, when you look at the kinds of jobs that we've been adding over the last year, mostly part-time jobs. We've seen real softness in full-time jobs, and we've seen real softness in also the consumer's ability to absorb where prices are. Even if the inflation rate isn't going up as much anymore, prices still aren't coming down. So prices are still an issue for consumers. And consumers are also going to have a hard time buying houses in here. Yes, the mortgage rates might come down a little bit, but prices are still very high. Home affordability is still very high. And so it's a tough environment. And I think investors need to be aware that the market may be more volatile. If we do enter a recession, it's very likely we would have a bear market next year. So I think we need to be careful about that.
So he said a lot of interesting things there, like preparing for a recession, even though it's not all that likely. But I know mostly what we heard is that recessions are bad for stocks. At least that's what I heard. And it freaks people out. They don't want to lose all the nice gains that they've had over the last 18 months or so. But I really do think it depends on what situation that you're in, which we've talked about this before. If you're close to retirement or in retirement where you're in capital preservation mode, then the risk of recession is something you should weigh. And if there are gains that you want to lock in, then it may make sense to do that. And ultimately, if you're wrong and the market keeps going up, that's okay, because remember, your main priority is capital preservation. So it's okay if you miss out on a little bit of gains because you've mitigated your biggest risk. That's what's most important. Now, the other scenario is if you're an active trader getting in and out of positions or the market overall, then obviously you may be looking to mitigate the risk of recession. But honestly, if you're in that camp and you're doing more active trading strategies, I'm guessing you're probably not watching my channel for insider thoughts on the market. Just a guess. Which means for the rest of us, we should probably be taking a different approach to this altogether, because ultimately, if you're long-term investing, a potential recession is not really about your portfolio value, at least not in the short term. And I'll explain what I mean in a second, but I want to play this last interview with Nancy Lazar from Piper Sandler, because while now everyone is saying that we're in the clear, she's holding her ground a little bit, and I really thought this interview was fascinating.
Does today's number prod you to adjust any forecasts?
It really doesn't. We've been expecting inflation to cool, and indeed there's been a package of data this week along with a PPI reading. We had the New York Fed consumer inflation expectations reading yesterday along with the small business inflation outlook. And so this just continues a trend of cooler inflation because the unemployment rate is increasing. It's not immaculate disinflation. We think it's because you are seeing a clear underlying weakness in the labor markets.
So does it allow the Fed the room to keep the focus on employment? And what do you think the calculus is right now for employers when it comes to hiring?
Well, corporate revenues are getting squeezed. We've seen it in a lot of the company comments during the second quarter earnings season. We think 3Q is going to be even more difficult. They're seeing their profit margins. Companies are seeing profit margins decline, in particular if you X out the Magnificent Six. And as a result, companies are trying to protect those profit margins, and they're doing that by increasing layoffs, not hiring. The rehiring rate is down sharply. And so that's leading to weakness in the labor markets, which is leading to weakness in consumer spending. Again, look at some of the earnings news out this morning. And as a result, that's putting downward pressure on companies' ability to hold price, forget about raising prices, they're going to try, but net prices are going to be under a lot of pressure.
But where do you think that goes? What does the shape of the unemployment rate look like? Is it just going to be like a slow rise? Is there a risk of a spike?
Yeah, we think we're entering a normal recession. By that, I mean GDP goes down about 1%, consumer spending declines about 1%, because the unemployment rate increases about 250 basis points. So right now, it's kind of a slow grind and still a huge debate on whether or not it's really increasing. We've laid out plenty of different data sets that do suggest the unemployment rate is increasing. Again, just ask Home Depot. And so at the end of the day, it's going to be a gradual rise, but classically, it does lead to a spike as you really see downward pressure on earnings. Companies really start to increase layoffs, and layoffs are starting to increase, but they probably will intensify as we go into the fourth quarter, taking the unemployment rate up towards 5% by the end of the year.
And what's great about this is that her thought process makes a ton of sense. And while everyone else is reacting mostly to those macro headlines and data points, she's saying, sure, we look at that, but simply just look at what the companies are reporting, and it tells a different story. And we've talked about these a lot in previous videos. I mean, McDonald's global comp sales down 1% last quarter, Starbucks sales down 3%, Macy's sales down 4%, Hershey sales down 16%. So it's been a common theme with a lot of companies. And Nancy continues on to finish the interview.
You just casually dropped the recession word, Nancy, which, it hasn't been the consensus. And even with sort of increased forecast for higher unemployment, most of your fellow economists think we can get away with a soft landing, and so does the Fed at this point. GDP is tracking, according to the Atlanta Fed, for this quarter, 2.9%.
Well, we think it's going to be weaker than that. We have our own GDP barometer, and it deteriorated quite sharply as we move through July and into early August. We'll get more better data on that later this week with retail sales. Second, if you look at historically, on average, it's taken 10 quarters after a Fed rate hike to move the economy into recession. Here in the third quarter of 2024, it is the 10th quarter, so we think we are now seeing greater risk of a recession unfolding. And then third, we have our own leading indicator, and it is suggesting that indeed the unemployment rate should be rising. And the leading indicator is based on things like the yield curve, just higher interest rates, money supply, housing, and they are all pointing to, no, this is just not a temporary blip in the unemployment rate. It is the beginning of a rising trend as the lagged effects of the Fed tightening cycle really start to squeeze corporate revenues, and that then leads to weaker employment initially, higher unemployment eventually, and then that really squeezes consumer spending. Again, just look at the companies. One of the things I constantly remind myself of is economic data are company data. and I've been keeping really close track of what companies say. I know nothing about them fundamentally, but I look at their revenues on the industrial side, on the consumer side, on the housing side, on the consumer goods side, service side, hotel, restaurants. There's a lot of negative commentary, and we're just moving into the retail season, and so this is going to be also very interesting as a picture of what the underlying trend in consumer spending is doing. And why are they shifting down? Because it's more difficult to get a job and wages are slowing.
So overall, I really thought that interview was great, and a lot of what she says makes sense to me. But I think what's missing in all these headlines and commentary is that the target audience probably isn't you or me. But for people like you and me, I think the approach to all this is much simpler and easier to act upon. Because first off, when it comes to recession, whether it happens or not, forget about your stocks or stock prices. Because the real potential challenge and risk is job loss or income loss. So step one, make sure that your income is stable. And if it's not, do whatever you have to do to get it stable. Step two, are there ways that you can actually increase your income? Now, whether that's getting a promotion at your current job, maybe looking for a new job, but that's a little bit dangerous, or building something on the side. Because the idea here is twofold. One, it can be a safety net to you if you do lose a job in the family or other income that you were expecting. But then two, it can give you that much more money to invest if stocks end up going down over the next year or so. And I actually think that is the most important point in all of this, that if you're still long-term investing, you shouldn't be worrying about a recession in terms of your portfolio performance. What you should care about is making sure that your income is good so that your family's okay, and then be prepared to buy as many stocks or ETFs that you can while prices go down. Because those bear markets are the best opportunities to accumulate, which will be the secret to your portfolio growth over time. So while people act like a recession is something for investors to worry about, I would argue something slightly different. That it's something to worry about from an income and personal finance standpoint, but for long-term investors, it's a potential big opportunity. So the preparation you should do is making sure your income is stable and have a plan of what you want to buy and accumulate if it ends up going on sale for the next year or so. Everything else, at least to me, is simply noise. Now, if you all are worried that the market is still overpriced and you want to know what to do about it, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.